First on the list is Salesforce, or as our investors calling it right now, Slamforce. Pretty fitting, right? The stock has gotten absolutely hammered, but when you actually crunch the numbers, a very different picture starts to emerge.
So let's look at the numbers from their model. In what they call the base case, they're projecting a potential return of 25 to 30% a year, every year, for the next 4 years. That is a massive return. But that's not even the most interesting part.
Here's the part that really got my attention. Even in their bear case, their worst case scenario where growth gets cut in half, the model still projects an 11 to 17% annual return. Just think about that. Even if things go kind of wrong, you could still beat the market's long-term average. That is a huge margin of safety.
All right, next up is Adobe. And the assumptions here are frankly super conservative. They're only plugging in 8% revenue growth and 10% profit growth. But even with those pretty modest numbers, you're still looking at a potential 21% return per year. You'd have to believe Adobe is basically falling off a cliff for this not to be an attractive price.
And the third one, a new buy, is a company called ServiceNow. Think of ServiceNow as the digital plumbing for massive corporations. They build the systems that automate pretty much everything: IT tickets, HR requests, you name it. And once a company's running on their platform, it is incredibly painful and expensive to switch. It's what you call a very sticky business. And this is where the long-term story gets really exciting. The bet here is that ServiceNow can keep growing its revenue by 15 to 25% a year, not just for a couple years, but way into the 2030s. Now, when a company's growing that fast, for that long, paying a price in the high 20s for its future earnings suddenly starts to look really, really cheap.